Good morning, friends. I'm Dr. Manu Ruby, Assistant Professor in the Department of Economics. So, students, in today's class, we are going to discuss about the trading, listing, preparation of the stock market, right? The stock market is actually considered as the stock exchange. It is a place where trade securities, it may be bonds or shares. The sellers of securities normally they are matching with their buyers in the stock market, and they trade with each other using rules imposed by the market government's authority. The stock markets began as the physical locations where traders gathered buy and selling shares, but most traders are not at all conducted online. See, some markets like the National Association of Securities, dealers, automated quotation do not have physical trading floors at all. But all transactions occur online. Others like this NYSE have a hybrid system in which physical trading comprises a small portion of the market's overall volume. Stock markets serve an important function in the economy by enabling entrepreneurs to raise capital and companies to expand their operations using funding from the markets. On the other side, stock markets generate profits for buyers of securities by making informed bets on growth prospects for these companies. These tasks are accomplished with the help of extensive regulation that govern trades and enforce mandatory disclosure of details from both sides. Depending on trading volume and economic conditions, stock markets can be a broad economy. See, for example, the Great Depression, it began with the stock market during 1929, that is 1930 itself. Similarly, major indices such stock markets during these financial crisis of 2008 and rose a new heights after a great recession of 2008. But there has been times when the market is disconnected from the mainstream economic program. See, for example, despite an almost complete economic shutdown and reports of record losses and unemployment numbers, markets in the United States reached new records during the COVID epics, right? See, as of 2020, NYSE was the biggest stock market in the world. So it had a market capitalism of more than 25 trillion, with a market cap of 11 trillion. Then let us clearly discuss about the classification of stock markets. So the first classification is preferred and common stocks. Next one is hybrid stocks. So let us discuss about the preferred and common stocks. The key difference between common and preferred stocks is in the proposed dividend payments. Preferred stocks promise investors that a fixed amount will be paid as dividends every year. A common stock doesn't come with a promise. For this reason, the price of a preferred stock is not little as that of a common stock. Another key difference between a common stock and a preferred stock is that the latter enjoy greater priority when the company is distributing surplus money. However, if the company is getting liquidated, its assets are being sold off to pay off investors. Then the claims of preferred shareholders rank below that of company's creditors and bond or debentures holders. Another difference is that preferred stockholders may not have voting rights unlike holders of common stocks. Next, let us discuss about the hybrid stock. See, some companies are issuing these hybrid stocks. These are often preferred. Some companies are issue hybrid stocks. These are often preferred shares that come with an option to be converted into a fixed number of common stocks at a specified time. These kinds of stocks are called convertible preferred shares. Since these are hybrid stocks, they may or may not have voting rights like common stocks. And the third classification is the stocks with embedded derivative options. So some stocks normally it comes with an embedded derivative option. It means it could be callable or puttable. A callable stock is one which has the option to be bought back by the company at a certain price or time. A puttable share gives the stockholder the option to sell it to the company at a prescribed time or price. These kinds of stocks are normally not available in the market, right? Then let us concentrate on the investor protection in the stock market. The investor protection is one of the crucial elements of a growing securities market. It focuses on making sure that investors are fully informed about their purchases, transactions, and the corporate offers and upgrades. Various procedures, the guidelines, rules, and regulations have been issued in the legislations to protect the investors' rights and repose their confidence. Investors are the pillars of the financial and securities market. They determine the level of activity in the market. They put the money in funds, stocks to help grow the market and the economy. It is therefore very important to protect the interest of the investor. See, the investor protection, it involves various measures established to protect the interest of investors from malpractices. Securities and Exchange Board of India is responsible for the regulations of the mutual funds and safeguard the interest of the investor. Investor protection measured by the SEBI are in place to safeguard the investors from the malpractices in shares, the stock market, mutual fund. Investor protection measures by SEBI investors are the pillars of the financial and securities market. They determine the level of activity in the market. They put the money in funds, stocks to help grow the market and thus the economy. It is very important to protect the interest of the investors. Investor protection measures by SEBI. Investor protection legislation is implemented under the section 11(2) of the SEBI Act. So the main measure are the stock exchange as well as other securities market business regulation. Registering and regulating the intermediaries of the business like brokers, transfer agents, bankers, trustees, registrars, portfolio managers, as well as the investor consultants, merchant bankers. Recording and monitoring the work of custodians, depositors, participants, foreign investors, credit rating agencies, registering investment schemes like mutual fund and venture capital funds and regulating their functioning. Promotion and controlling of self-regulatory companies, keeping a check on frauds and unfair trading methods release of the securities market. Observing and regulating major transactions and takeover of the companies. Carry out investor awareness and education program. Train the intermediaries of the business, inspecting and auditing the security exchanges and intermediaries, assessment of fees and other charges. Then let us concentrate on the issues of insider trading. See, insider trading is defined as a malpractice wherein trade of a company's securities is undertaken by people who, by virtue of their work, have access to the otherwise non-public information. So, which can be crucial for making investment decisions. For insiders, example, key employees or executives who have access to the strategic information about the company use the same for trading in the company's stock or securities. Normally, it is called insider trading and is highly discouraged by the Securities and Exchange Board of India to promote fair trading in the market for the benefit of the common investor. Insider trading is an unfair practice wherein the stockholders are at a great disadvantage due to the lack of important insider non-public information. However, in certain cases, if the information has been made public in a way that all concerned investors have access to it, that will not be a case of illegal insider trading. Insider trading involves trading in a public company's stock by someone who has non-public material information about the stock for any reason. Insider trading can be either illegal or legal depending on when the insider makes the trade. Insider trading is illegal when the material information is still non-public, and this sort of insider trading comes with the harsh consequences. Material information is any information that could substantially impact an investor's decision to buy or sell the security. Non-public information is the information that is not legally available to the public. So the question of legality stems from the SEC's attempt to maintain a fair marketplace. An individual who has access to insider information would have an unfair edge over other investors who do not have the same access and could potentially make larger unfair profits than their fellow investors. Illegal insider trading includes tipping others when we have any sort of material non-public information. Legal insider trading happens when directors of the company purchase or sell shares, but they disclose their transactions legally. The Securities and Exchange Commission has legal to protect investments from the effects of insider trading. It doesn't matter how the material non-public information was received or if the person is employed by the company. For example, suppose someone learns about non-public material information from a family member and shares it with a friend. The friend uses the insider information to profit in the stock market. Then all the three people involved could be prosecuted, right? The trading system in the stock market. If we see this trading system in the stock market, before selling the securities to this stock market to this stock exchange, the companies have to get their securities listed in the stock exchange. The name of the company is included in listed securities only when stock exchange authorities are satisfied with the financial soundness and other aspects of the company. Then the next thing is the trading procedure on a stock exchange. The trading procedure involves the following steps. The main steps are selection of a broker. The buying and the selling of securities can only be done through SEBI registered brokers or members of the stock exchange. The broker can be an individual partnership firms or corporate bodies. So the first step is to select a broker who will buy or sell the securities on behalf of the investor or a speculator, right? And the next thing is opening these demat account with depository. So demat in the sense it is a dematerialized account. It refers to an account which an Indian citizen must open with a depository participant to trade in listed securities in electronic form. Second step in trading procedure is to open a demat account. The securities are held in the electronic form by a depository. The depository is an institution or an organization which holds securities. So debentures or bonds or mutual funds. At present in India, these are two depositories. That is the NSDL, it means National Securities Depository Limited, and CDSL, that is the Central Depository Services Limited. See, actually, there is no direct contact between this depository and the investor. The depository is an institution or an organization which holds securities. Debentures or bonds or mutual funds at present in India, there are two depositories. One is this NSDL and another one is this CDSL. Depository interacts with the investors through depository participants only. Depository participants will remain securities account balances of investor and intimate investor about the status of their holding from time to time. The next thing is placing the order. See, after opening this demat account, the investor can place the order. The order can be placed by to a broker either personally or through email. See, executing the order as per the instructions of the investor, the broker executes the order. That is, he buys and sells the securities. Broker prepares a contract note for the order executed. The contract note contains the name and the price of securities, name of the parties, and the brokerage charge by him. The contract note is signed by the broker. So the final one is the settlement. So it means actual transfer of securities. So actually, it is the last stage in the trading of securities, which is done by the broker on behalf of the clients. Normally, there are two types of settlement, right? Okay, students, the remaining aspect we will discuss in the next class. Thank you.